what's up guys, John here. Elon Musk just came out and said that there's a lot of current year similarities to 1929. Now, a lot of people don't realize what happened in 1929. It was a run on the banks. Bank collapses occurred in commonplace. People went through a real life change through 1929, and it wasn't something that ended quickly. It was a multi-year punishment that happened to the citizens. And that's what I believe is about to happen in America. I'm not saying this to scare anyone, but when you look at what's going on with Wells Fargo, you look at what's going on with all these regional banks, you look at what's going on with Credit Suisse, you look at what the Fed is doing, what Biden is doing, you look at all of these things and you put it together and you ask yourself, what does this mean? And it means that we're stepping into an economic hell to the likes in which we've never seen before. And I'm going to walk you through how this plays out. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate more people about what's going on. I'm not trying to scare anybody, but what I am trying to do is help people make smart financial decisions, help people position themselves for the chaos that looks like we're rolling into right now. In the last couple of years, a lot of people are just making money hand over fist, and now a lot of people waking up saying, you know what, this is probably going to get pretty bad. Right? This isn't going to be something where, we're going to buy the dip and we're going to go out there and buy some type of Dogecoin or some type of meme stock. A lot of people are over that. A lot of people are starting to get really defensive. They're getting scared. They're getting nervous, and for good reason. I mean, take a look at this. So, Elon Musk, a lot of current year similarities to 1929. Wells Fargo, they're planning to raise $9.5 billion through a mixed securities shelf offering. So why does Wells Fargo need to raise $9.5 billion if everything is so great, right? It's because they're in big trouble. And a lot of big banks, a lot of people think that, hey, I'm in Bank of America, I'm in JP Morgan, I'm in Wells, I'm in one of these big banks. The last couple weeks, this has been incredible for the stability of these big banks because people are leaving regional banks and putting all their money in these big banks. So people have a peace of mind, at least they think they do, with being one of these big banks. So what they don't realize is these big banks are straddled in debt. They are to their teeth in risk, and as this economy starts to crack, with it goes, I think, some of these really big banks. Wells Fargo has announced its plan to raise funds through a mixed securities shelf offering to secure $9.5 billion in the capital. This move is part of the bank's ongoing efforts to strengthen its financial position and improve its balance sheet. Well, you think of what is their balance sheet? How do they make money? Well, banks make money by taking your deposits and lending it out. Whether it be on auto loans, real estate, whether it be on credit cards, they lend it out. They give you a small percentage, basically nothing. And then they take that large percentage of the interest that's accrued during those said investments. They pay their expenses and, the stock and the business as a whole does well. But what happens when the loans in which they issued are underperforming? For example, auto loans. People are paying 30, 40, 50% above sticker price over the last couple of years for these auto loans. And there's trillions and trillions of dollars in these auto loans. When the economy starts to tank and layoffs begin to occur, people start to walk away from these payments in which they can't afford, especially as the Fed continues to increase interest rates and the cost to service these car loans gets more and more expensive, which is a really big problem for these banks. And then the same occurs with residential real estate. Residential real estate, the average down payment for a first-time home buyer on residential real estate was 5%. For a second-time buyer, 13%. So on average, give or take 9 or 10% as a down payment. You have a 6%, maybe 7% cost of sale. 5% goes to agent fees. You have maybe a percent going to transfer taxes, escrow, title, right? You have maybe 3 or 4% equity if you were able to sell at the same price as what you paid. But let's not forget, interest rates went from 3% to 7%, and people don't have equity that just recently purchased in most cases. So you start to look at their balance sheet. They have bad auto loans. They have bad real estate loans. They have commercial loans that are starting to really step into a really bad situation. Commercial, you have higher vacancies. You have more tenants that are unable to pay. You have increased property insurance, increased property taxes, and increased interest rates. A lot of these commercial loans are going to be set to refinance. They're going to have to refinance them this year or next year. I think it was something like $140 billion worth of refis are occurring in the commercial sector in the next 24 months, and 1 out of 3 commercial properties our commercial mortgages are floating rate, meaning that their costs are already just continuing to rise. So you start to look at this, you ask yourself, how are banks going to remain solvent when they have only $1 trillion in overall consumer deposits, and now consumers have more debt than they do deposits? So, as Ken Griffin said at Citadel, he said that consumers right now are taking out about $100 billion a month from their banks to service debt. So how are these banks going to remain strong if their deposits are getting diminished and their exposure is only growing by the day? Right now, Credit Suisse, we've heard about this. Their stock plummeted 60%. People are getting really scared about Credit Suisse. And in a surprising move, the Fed also said that they would offer cash loans up to a year for any bank putting up safe collateral. You think about what that means, safe collateral. Why would they need to put up safe collateral if the collateral was safe? If they had something that was worth $1 billion, why would they need to put up that $1 billion in safe collateral for $1 billion from the Fed? They wouldn't. They would find another solution, right? So this is, when they talk like this, they basically are letting us know that these banks are not that safe. In theory, that would allow the banks to handle deposit withdrawals for any amount as authorities seek to reassure people that don't need to take their money out at all, right? They're trying to stop that run in the banks. But in March 26, 2020, they reduced the reserve requirement ratios for net transactions for banks to 0%. So back then, banks were making money hand over fist. They were crushing it with loan originations. They were just making so much money and all these fees, all this money that they were able to lend out. And now that show is coming to a close. As this all happens, and people don't know this, they make the money from the deposits in which they lend. But when they can't do these bank loans, like to put it into context, these big banks, because everyone, I get messages all the time, people saying, oh, I'm at a big bank. These banks are too big to fail. Look at Wells Fargo, right? They're raising $9.5 billion, and they're alongside these other banks that are going through the same exact situation. And I bank at some of these banks, at least currently, and that's going to change. Wells Fargo, the third largest U.S. mortgage lender by volume, originated $14.6 billion in mortgages. From October to December, down 32% quarter over quarter, 70% year over year. Refis fell to 13% from the portfolio's Q4 2024 compared to 59% in Q4 2021. Meanwhile, JP Morgan Chase, the fifth biggest mortgage lender in the country, origination volume totaled just $6.7 billion. I mean, that's pretty small. $6.7 billion for Q4 2022, a decline of 45% compared to the prior quarter, and 84% drop in Q4 2021. B of A, number 10 among the top U.S. mortgage lenders, produced $5.4 billion in mortgages during Q4 2022, a 40% drop from $8.7 billion recorded in the previous quarter, and 77% below the $23 billion notched in Q4 2021. I mean, so you're starting to see it. And you're also starting to hear more and more and more about layoffs. Meta just laid off 10,000 people today. All these layoffs are going to do something. They're going to do something very, very big to this economy. What's it going to do? It's going to start to signal to small business owners, to everyone, that, the big guys, they are laying off. They're getting scared. And it's going to basically signal to everyone else, hey, if they're saying, if all the big tech companies are laying everyone off, and we're seeing all this fear in the news, maybe I should be more defensive. And that's what happens. People start to, fear is contagious. So people start to get more and more and more scared, and they start to show this with their spending habits, with their employment habits, with how they operate and run their business. I mentioned this before lightly, but this 47% increase in used car prices, people are paying that. When they're putting just down such a small down payment deposit, you have to ask yourself, how are people going to be able to hold on to this? How are they going to be able to hold on to these cars? And as emergency savings drop and credit card debt rises, an ugly stew is brewing. And this guy is going to save the U.S. banking system? No, this banking system can't be saved, in my opinion, because there's so much leverage in this system, and we're not going to be able to get out of it, especially as we start to easily. Anyway, we're not going to be able to get out of this situation easily. Eventually, sure, we're going to find some type of solution, but I think we're going to see a rough couple years ahead, a very, very, very rough couple years ahead. Something broke, but the Fed is still expected to go through with rate hikes. they are going to continue to increase interest rates. They are. And so as they do this, what are people going to do? They're going to look and say, hey, maybe I'm sitting on $100,000. Maybe I'm sitting on $200,000 or I'm sitting on $20,000. If I let it sit in the bank and my purchasing power is getting eroded due to inflation, it makes more sense to take the money out of the bank, which is also bad for the banks, and buy treasuries. Get 4%, 5% treasuries, even though they're still losing money because of inflation. And people, I think, know inflation is probably worse than 6%. So if they're getting 4 to 5%, they're still losing money. But if they were to invest it in stocks, they were to invest it in certain real estate assets, they were to invest it in certain other areas, the risk exposure is much greater. And people right now are more defensive, which makes sense. But what do you think? Do you think that we're stepping into what Elon Musk is saying, similarities to 1929? 1929, people don't understand what that really means. In 1929, it was a real humbling experience. If you ever watched any documentary, you ever watched anything, you learned anything, it was the greatest wealth transfer of all time. It was the transfer of wealth from the majority to the minority. And so if you want to be in that, you want to position yourself, you need to make sure you're out of high interest rate consumer credit card debt. That is going to be one of the biggest nooses on the general public, is these high interest 25, 30, 32% credit card interest rates. Loan sharks, they charge less than that. What you want to do is get out of this. Right now, there's still banks offering these 0% balance transfers. Start shopping them around, start looking at them. You need like a 700 credit score in many cases to get there. So if you don't have it, we would love to help you at GreatCreditFast.com. But consider all of these options. Start to really play defensively. I believe there's going to be incredible opportunities when you start to look at the debt in the system, whether it be residential, commercial real estate, auto loans. I think there's going to be great opportunities with luxury watches and collectibles. I think we're going to start to see a lot of people sell things they would have never imagined just because they have no choice but to sell. They need the money. And so you want to position yourself to where you can grow during these uncertain times, because the more financial security you have during the times of chaos, the more peace of mind for yourself and your family. So if you need help fixing your credit, again, we'd love to help you at GreatCreditFast.com. Give us a call at 561-430-5900. Subscribe here on my second channel and on Instagram for short form content. You can click the hyperlink in the banner above. Catch you guys in the next one.